we follow something called a marginal tax rate, which means that the tax rate you pay depends on which bracket that you're in. So, for example, let's assume that you make $100,000 a year, and these are numbers based on you filing your taxes as a married couple jointly. So if you and your spouse make $100,000 a year, you would fall right here. So from the first zero to $19,900, you would pay 10% of that money in taxes. Then for every dollar you earn between $19,901 to $81,050, you'd pay 12% of the money in taxes. And then between $18,051 and $100,000, you'd pay 22% of that money in taxes. So because you made $100,000 a year in taxes, you're not going to pay 22% flat on your taxes. You're going to pay that marginal tax rate. You're going to pay 10% of your taxes on the first almost 20,000, then 12% in taxes on the next 60 or so thousand, and then you're going to pay 22% taxes on whatever's left. So that's how marginal tax rates work. What President Biden wants to do is he wants to change the top tax rate from 37% to 39.6%, and he wants that to start here at $450,000. So let me just draw this out right here. If we make this $450,000, he wants to change the top tax rate to 39.6. So if you are a married couple and you make over $450,000 a year, what that means is that your top tax rate is going to be 39.6%. So we could see some other adjustment here to help organize the brackets a little bit better. But what that means is the top tax rate is going to go up from 37% to 39.6%, and the top tax rate is going to start a whole lot lower than $628,000. Now, this proposal hasn't gone through yet, but if it goes through Congress, this new higher tax rate would start applying to your 2023 income. Second, President Biden wants to increase taxes on corporations. So in 2022, corporations are paying a 21% corporate tax rate, or at least this is what the tax code says they're supposed to pay. Obviously, a lot of corporations take deductions and other loopholes that they can find legally, which allow them to pay less money in taxes, but this is what they're paying, and President Biden wants to raise this to 28%. Now, if you really want to understand the implications of this, you need to understand how corporate taxes work. So the way corporate taxes work is like this. Let's assume that you have these two people, this person with a nice mustache and this lady right here with a nice braid, or as we like to call it in my native language, Punjabi, a gut. These two people own this company. And this company is a corporation, and it's in the business of selling guacamole. So let's assume now that over the course of the year, this company makes $1 million in revenue, and then it has to pay all of its costs to run the business. Let's assume, for the sake of this example, that it has $500,000 in operating costs. You pay your employees, you pay your operational costs, you pay your materials costs, which leaves you with $500,000 in the bank account. Now, this $500,000 is the money that the owners get. It's their profit. Now, if this money stays in the bank account, this corporation is going to have to pay taxes on this profit. So the corporation is going to have to pay taxes. In this case, it's 21% in 2022. If this proposal gets approved, it will go up to 28%. So now this corporation pays taxes right here. And if it pays just 20%, so let's assume for the sake of this example that it's 20% just for round numbers, that means there's $400,000 left in the corporation, which can now be distributed to the owners. Third, and the biggest thing that President Biden wants to do is he wants to create a tax on unrealized gains for wealthy people. So the way it works is if you are worth over $100 million, he wants to impose a minimum 20% tax on all gains, realized or unrealized. So let me show you what that means. So to reduce the numbers and make it a little bit easier to understand, let's assume that you go out and you buy a stock on the stock market right now for $100 a share. A number of years go by and the stock goes up in price to $1,000 a share. Now, you don't actually make any money unless you sell that stock. But what this proposal says is if you are worth over $100 million, you would still pay taxes today on this $900 worth of unrealized profit. So I'm not going to call it profit, I'm going to call it profit. You would have $900 worth of taxable income even though you don't actually have any income, because on paper your wealth has gone up. So another way to think about it is you bought a home for $200,000 and now this home is worth say $1 million, but you don't sell it. You're just living in this home, but on paper, you think it's worth $1 million because Zillow says your home's worth $1 million. And because you have this unrealized gain, you have a taxable event in this case. And in this case, President Biden says you'd have to pay a minimum 20% tax on all of these unrealized gains. The whole idea behind doing this is it wants to start taxing the ultra wealthy people who are living off of their unrealized profits. So the biggest example of this is Elon Musk. Elon Musk hasn't been paid a salary for working at Tesla. Instead, he's been getting stock options, and he got tens of millions of stock options to buy the Tesla stock at $6 a share. And then when the stock went up to over $1,000 a share, this stock options that he had were worth billions and billions of dollars. And instead of going out and selling his stock options, what he did was he borrowed against it. He took out debt against his stock options. Debt isn't taxable. When you go and get a mortgage, you're not paying taxes on the debt that you get. When you refinance your mortgage, you don't pay any taxes on that. So what he did was he borrowed against it. Essentially, he refinanced against the value of his Tesla shares, and he lived off of that and didn't pay any money in taxes. So this new proposed tax would not allow somebody to do this. Now you'd have to pay taxes on this income, even though it's not actually income because you have no money in your pocket. This is all dependent on the current values of your asset. Now, pretty easily, you can start to see where the issues would arrive, because what happens now if you have this $1,000 worth of profit here, or unrealized profit that you have to pay taxes on, and the next year you have a stock market crash, and now next year it goes down to $500 a share. Now what's gonna happen? Are you gonna get a tax refund? I don't know why I wrote a K here, but are you gonna get a tax refund? Are you gonna get your money back? Or what happens if the stock goes down to zero? Then what happens? If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.